Hey everybody, welcome back to Actual Investing. Stocks across the board are on deep discounts today, and I don't know about you guys, but I love a good discount. I'm a bit of a bargain hunter, let's be honest. So today we're going to talk about 2 of the 4 stocks that I bought today. So really quick, for anybody who's just a bit nervous or worried about their portfolio during this downturn, I want to share something that my father-in-law said to me today that I found just really simple and comforting. My father-in-law and I like to talk about stocks together. He'll usually text me and ask what stocks he should buy, and I say, I don't know, I can't really tell you. But because I'm not going to tell him what ones to buy, but I sometimes talk about the ones that I like and let him go out and do his own research. Anyway, today we were talking about the downturn, and he said something very simple. He said, "We're in a storm, but it will pass." And I like that. It's so true. When stocks are falling, that's the perfect time to buy because everybody's worried. They start second guessing themselves and start selling off their shares. Well, that's just a great opportunity for you who has a strong stomach, right? And who isn't worried and who's going to swoop in and buy those cheap shares. And sure, stocks could keep going down further. I'm not saying that this is any kind of bottom or anything, but I just mean that if you are adding money to your portfolio and you are dollar cost averaging, these dips just make for great opportunities for long-term investors. So with that out of the way, let's talk about the first stock I bought today, which is Synopsys, ticker SNPS. Synopsys is a stock that I used to own and I sold it just due to the valuation. Their price had been appreciating really rapidly during the AI boom, and I thought that maybe it wasn't sustainable, and that ended up being a pretty smart move. I sold in the high 500s, and it's now in the high 400s, so I figured I may as well get back in because the valuation makes a lot more sense, which we'll talk about. But quickly, what does Synopsys do? Well, their primary business is something called EDA, or electronic design automation software, for semiconductor designers. So companies like NVIDIA and AMD use Synopsys' software to help design new high-tech semiconductors. Synopsys defines EDA as software, hardware, and services with a collective goal of assisting in the definition, planning, design, implementation, verification, and manufacturing of semiconductor devices. So Synopsys and their rival Cadence, which is their key competitor, are really integral to the semiconductor industry, and without electronic design automation, semiconductor designers like NVIDIA and AMD would not be able to create their designs or get them to market. So this is a really key picks and shovels play on the semiconductor industry. And as you can probably imagine, this company has been doing really well lately because of the huge demand for semiconductors in lots of different industries, primarily those for high performance computing. So we can see that in fiscal 2023, they grew their revenue 15% year over year, and they're looking at the same growth for fiscal 2024, which is even more impressive because growing a larger revenue number is much more difficult than growing a smaller revenue number. They're also looking at operating margin improvement and earnings per share improvement. The nice thing about Synopsys is that since electronic design automation is primarily software-based, they do have this nice recurring revenue model where people subscribe to their sort of SaaS offering, and it keeps them coming back year after year. The other aspect of their business is this semiconductor intellectual property, or IP business. So essentially they have a broad portfolio of intellectual property, and to be totally honest, some of this stuff goes over my head, but what they can do is license this IP to semiconductor designers. So those crucial services for the semiconductor industry are what have caused Synopsys to become a $77 billion company. Today, the stock was down 9%, and I had it on my watch list with a target of $500 per share to get back in. That would put the valuation at around 13 to 13.5 times price to annualized sales, and I thought that that was reasonable, so I did start to dollar cost average back into my Synopsys position today. I think the primary reason for the drop is partially because of Intel's earnings report, right, and had some weak guidance, and I believe that companies like Synopsys, of which Intel is a customer, I think they're going to see a little bit of correlation with companies like Intel, unfortunately. However, Synopsys is not the same as Intel. Synopsys is actually executing very well. Like I said, 15% year-over-year revenue growth, net income also growing, not quite as rapidly, but when we look at the long term, we can see that this is very steady revenue growth due to that software-based business model. They also have a really nice balance sheet. They have just over $1.5 billion in cash and $11 billion in assets, with only less than $4 billion in liabilities. Not too bad. One thing to note about Synopsys is they are currently in the process of acquiring a company called Ansys, which actually Ansys was on my watch list as well. So now that Synopsys is acquiring them, I guess I will also be acquiring them. Synopsys has added Ansys to their portfolio to help cement their leadership position in silicon to system design solutions. They say here that Ansys is a global leader in simulation. So Ansys is, that's a weird word to say, Ansys is Ansys's software, that is grammatically correct, Ansys's software helps companies to simulate what a product might actually look like or how it might perform in the real world. And this has a lot of applications to electronic components like semiconductors. So this acquisition does kind of make a lot of sense. Synopsys helping semiconductors actually design their equipment, and Ansys helping them see what it's going to look like and how it's going to perform in the real world. I think this is going to be a huge value add for Synopsys, and even though I think they overpaid for the acquisition, that's neither here nor there. Synopsys estimates that this acquisition of Ansys is going to expand their TAM, or total addressable market, by about 1.5 times, and will grow at an 11% compound annual growth rate, so that 15% revenue growth that we saw should hopefully continue, or at least be quite similar in the near future. So I love to see that. Synopsys, I think, still has a bright future ahead of it, and I think this acquisition of Ansys makes a ton of sense, even if it was pricey. When we look at my disruptive growth stock spreadsheet, where I rate growth stocks on 4 factors, Synopsys is actually one of the highest scoring stocks on the sheet. So essentially what I do is I look at a company's gross margins, the total revenue that they've captured, their valuation on a price to sales basis, and their year-over-year revenue growth, and I give the company a score with a possible 5 points from each metric, so a possible total score of 20. Synopsys gets a score of 13.7, and that's only because I have not updated their revenue growth number, but still they get a score of 13.2, which is well above my average on my spreadsheet. What I like about Synopsys is their strong gross margins of 79%. Like I said, they are mostly a software business, so software as a service companies do tend to have very strong gross margins, and Synopsys is no exception. Their valuation is quite low for a software company at just 13.4 times annualized sales. For example, a company like Palantir that's growing about the same rate has a price to annualized sales of 19. The other thing I like about Synopsys is that their operating expenses are on the lower side, with SG&A to gross profit of just 29% and R&D to gross profit of 42%, which is on the higher end, but also low for the semiconductor industry. So Synopsys, I'm happy to continue dollar cost averaging. Let's quickly talk about the other stock that I added to, which is Applied Materials, ticker AMAT, also down 6.5% today, but if we zoom out, they're also down 24% over the past month. Yikes. Now, over the long term, they are still doing well, but I think that this recent dip provides a nice opportunity to continue dollar cost averaging into what I believe is a wonderful company at a wonderful price. So I've talked about Applied Materials previously on my portfolio video. It is one of my top holdings, especially now after buying the dip. So I won't spend too much time on them today, but what I think is interesting is that they are a key supplier to the semiconductor manufacturing industry. So they provide equipment to help companies actually manufacture semiconductors, and they have the broadest portfolio of semiconductor manufacturing equipment out there on the market. I talked a bit about ASML, which is specialized in lithography equipment. Applied Materials is kind of the opposite. They're not specialized, they are a jack of all trades. Two potential growth drivers that I see for Applied Materials are the growth of DRAM, or DRAM, I believe it's DRAM, which stands for Dynamic Random Access Memory, and it's said to be a big business, at least according to HP, with a market totaling $17.5 billion in the third quarter of 2020. So I would love to see how that has expanded, because I'm sure it has. DRAM helps access memory much more quickly, and Applied Materials is increasing their market share in the DRAM market. They're also positioned for future growth with some of the products that they sell specifically for DRAM applications. Another growth driver would be high bandwidth memory, or HBM. They are the #1 supplier for HBM process equipment, and they're expecting their HBM packaging revenue to grow 4 times in the current fiscal year. That's amazing. When we look at high bandwidth memory, this is a way to significantly increase performance of a computer, and the applications for that are quite clear now that generative AI is taking the world by storm, and the need for high performance computing is growing and growing. So Applied Materials I happen to like a lot. What's interesting is that if we look at quarterly year-over-year revenue growth, they only grew their revenue by less than 1% year-over-year, but 2024 is kind of a transitionary year for the broader semiconductor industry. Even though companies like NVIDIA and Broadcom are seeing huge demand, the semiconductor industry as a whole is actually in a downturn, with 2025 projected to be a recovery year. So the fact that Applied Materials actually didn't even see negative growth this year, I think bodes very well for them. And keep in mind that with each quarter that passes, they are making profits, so even if there's no growth, they are still turning a profit. Applied Materials has a really solid balance sheet with about $7.5 billion in cash that they can use, and they are free cash flow positive with almost $1 billion in free cash flow in the last quarter. Like I said, I believe this is a wonderful company at a wonderful price. So those are 2 of the 4 stocks that I bought today, Synopsys and Applied Materials. If you want to see the other 2 stocks, I do offer a YouTube membership that you can join for $2 a month. There was a little shameless plug where I post my trades in real time. Don't feel like you have to do that. It's just something that YouTube suggested I offer in order to increase engagement, and in case anybody wanted to support the channel, that's a great way to do so. But honestly, just you watching the video to the end really helps me out a lot. Thank you so much for watching the video, and I hope you guys all have a great day and a wonderful weekend.